Are you selling options to hedge positions? Hi, I'm Larry Gaines, Power Cycle Trading, and in this video I'm going to show you an example of how you can incorporate selling options to help neutralize risk, reduce risk, and hedge a position. So this is JP Morgan, so it's in what we call a volatility squeeze here. You can see the daily time frame, and you can see how price is just kind of churning sideways right here. So this is a trade setup that we did was on the 19th here, we had a nice momentum kind of spike. It looked like JP Morgan was getting ready to break out to the upside. So went long JP Morgan. And now you could have done that a couple different ways, but the trade setup we did was using a long call debit spread. So bought a 111 call, sold the 114 against it. So call debit spread. And then the plan was if we got a spike the next day or any day after and went up towards this 50% retracement a little bit higher, we would then look to sell an out of the money, what we call bear call credit spread, to bring in some premium and also then to hedge the position, neutralize it a little bit, and buy some time until this thing was to potentially break out to the upside. So let's take a look. First off, though, you always want to have a target in place when you put a trade on. So our target was to push to the 618 retracement here, so 114. So that's why we set up a 111, 114 vertical call debit spread. And then we were looking at a potential for kind of an upside move, maybe to the 116, 118 level. So when it spiked up here on the 20th, sold the out of the money bear call credit spread, the 115 up here, 118. So the initial trade was buying the May 11 series 111, 114 call debit spread, paid $1.20. All right, so then the next day on the 20th, the market spiked and we sold the 115, 118 bear call credit spread, brought in $50 credit or 50 cents. So this neutralized the downside risk a little bit, reducing it by the credit brought in of $50 or 50 cents. So now the downside risk is $70. If it really blows to the upside at 70, but we have a really nice profit window in here. So basically from, about 112 all the way up here to 116, and the max profit would be if it went out right in there. The max profit would be out if it went out between the two short strikes, the 114, 115 at expiration. That would be $230 on a risk of 70, so that's over a 300% return. But what tends to happen a lot of times, you'll get into a trade, and especially in this kind of market with a lot of uncertainty, and then the market stalls and it starts to come off. So you can see now that this trade right here today is now down. If you just did the call debit spread, you can see that it's churning and it's down to 98 cents or $22 per option spread. And also you can look here and see the theta. So it's got negative theta. So every day this doesn't move to the upside, this call debit spread is losing $1.84 per spread. All right, so that $1.20 is going down. All right, so to offset that theta decay, that's the other beauty of selling a credit spread against it. In this situation, the 115, 118. So sold that, brought in 50-cent credit. You can see now the theta is almost zero or neutral, and this trade is still at a break even. So now you've got a lot of different options. You can just sit and wait and see if this thing will come back. And if it does, we could close out the called credit spread. We could close that out right now at 20, 21 cents. So that would be 30 cents profit. And then that would adjust down the call debit spread by 30 cents. So you'd actually maybe be in this for 90 cents to debit. All right, I hope this helps. Talk to you on my next video update.